Okay, good evening, everyone. Welcome to the Anderson Report. This is Thursday, August 27th. We have a few very interesting comments to go, topics to go over tonight. We're going to talk about the Fed and Chairman Powell's speech at Jackson Hole. Mark, it's great to have you with us again tonight. We're going to talk about the market today. Maybe we had a little bit what we've been saying we'd like to see, in that the Nasdaq pulled back a touch. Uh, S&P still made a new high. The S&P has made a new high now for 6 days. I don't know if it's 6 or 7 days, but whether it's 5, 6, or 7 days in a row that the S&P 500 has posted a new all-time high, it's the longest streak since early 2018. So that 2.5 years, 30 months, a streak of all-time highs for the S&P 500 after failing at that data point 3 or 4 times about a week and a half ago. So, and we had a little bit better internals for the market today. Um, and we're going to go over a number of these things. We're going to explain what the Fed did, hopefully in English, not in Fed speak. Although Chairman Powell, not being a academically trained PhD economist, is a little bit of a breath of fresh air from the last few Fed chairmen and chairwomen. Um, and I thought he was pretty clear what he was saying, and I think that the market certainly got the message loud and clear. Also, even though the Nasdaq reversed its early gains and closed um, slightly in negative territory, certainly not a big reversal, although some stocks in the sector had bigger reversals. So, this is the Anderson Report. I'm Tim the Source Anderson. This is my YouTube channel, The Anderson Report. We do this about maybe 5 nights a week, maybe a little bit more than maybe a sixth night, sometimes on Sundays, depending on what the news cycle's like and how significant the market action and the economic data have been during that day. I like to get things to people as freshly as possible. And what we're really going to try to do tonight, we're going to get 2 hours of information into about 40 minutes. So we seem to have the chat issues fixed in the chat. And we're going to just get into it pretty much right now. So we'll talk about the market action first. The Dow had a nice gain. It was as much as 100 points higher at one point in time. It closed up with a gain of 160 points, 28,492, just below the 28,500 level. So the Dow Jones Industrial Average now is about 1,070 points, a little bit less than 1,100 points from a new closing high. Also, the Dow, with its close today, is in positive territory year to date. The industrials have been strong. The material stocks have been strong. And one of the sectors that's just been teasing us relentlessly for a couple months on and off, the financials had a very nice day today. The S&P 500 only up about 6 points. That's only about 0.2%, but it was a new closing high, 34.85 spot 55. The S&P 500 scratched the 3,500 level a couple of times during the day, couldn't close above that level. We did have one, I'm not going to say a sharp sell off, but we did have one period during the day from about maybe 10 o'clock until maybe 11 o'clock, 11:15, when the market sold off quite a bit from very high levels. The VIX rallied sharply, uh, thinking that maybe this was going to be a big correction day, which it really wasn't, because then after about 1 o'clock, the the major market averages pretty much and the market overall found a support level. It was right around where things were just slightly negative on the day, rallied throughout the last 2 hours of the day, maybe the last 2.5 hours of the day. Um, the Nasdaq ended up with a slight decline, but look at the move the Nasdaq's had. Okay, I'll take it. I would actually like to see the Nasdaq, um, consolidate its gains over the next week or so without it turning into a bloodbath on the downside. We certainly don't want to see the Nasdaq go down like 7 or 8% in 3 days, and then have people saying, well, "What happened? What's wrong here?" Blah 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 blah. Come on, it's up 23, 24% year to date. It's due for a pause. The Nasdaq down 1/3%, down 40 points, 11,625. I would just call that a pause. Now, you did have a couple of stocks like Facebook, which we highlighted yesterday, was up 9% or 8% yesterday. Facebook was up strong, 8 or 9 points right out of the chute, ended up down 8 or 9 points. The stocks had a big run. Okay. I'm not going to go through a big list of a lot of other stocks that, in terms of what their price action was, but the Nasdaq, a mild decline today. We'll take it. It's overdue. It's what we call a little bit of mean reversion, where things that were just so far ahead of themselves and then correct a little bit, and some sectors that are way behind, they move up a little bit higher, and that's mean reversion. That over time, if you're way too high above the 200-day or 50-day moving averages, mainly the 50-day moving average, if stocks have been up too many days in a row, if the gains month to date, quarter to date are just very, very strong, you've got to have a pause to it, like a pause that refreshes, and or just at least some price consolidation, and to get people so that they're not so aggressively chasing price performance and price momentum. Okay. Look, earnings momentum and price momentum are two different things, obviously, the same way that the market is very different on occasion from the economy. Plank owner is asking a question that gives me a little hint as to maybe what line of business he's in. He's asking what goes on with lumber prices. If you could put in the chat what they've done over the last week. I know that as of 10 days ago or so, lumber was trading at its highs of the year, maybe its high in 18 months. I don't follow the lumber prices as closely as I should, but given what's going on with the home builders, and given that there is a shortage in the home building space, a shortage of new homes, for a few different reasons, and given that mortgage rates are holding that 3% historically very, very low, very, very attractive level for first-time buyers and or second-time buyers or people that are moving. And given that copper prices have been scratching that $3 level, I think they were at $1.80 at the depths of the sell-off in March. Will housing? I just think that lumber is just uh, it's got to be. It's a hot commodity right now. It's going to continue to be. I would expect that those prices. And again, I'm not familiar with the chart, but I know that a week and a half ago they were trading at either a 52-week high or maybe an 18-month high, maybe a 2-year high. They could consolidate a little bit, but they're not going to have a big correction from this level for a while. Will housing prices go up? Yes, they will, and yes, they have been. And I don't have the most current data, but if you look at the existing home price sales, and if you look at new home sales, and if you look at some of the Case Schuler and some of the other reports that have come out over the last 6 weeks, and even over the last 2 to 3 weeks, this is becoming a trend. I think through most of 2018 and 2019, we would have a couple of weeks of good data on the housing market, and then we'd have a week to a week and a half of so-so data or a little bit of a pullback. Then we'd have a week of good data. Then we'd have a week of, okay, maybe it's not really right. Maybe it's not really starting yet. Nothing that really developed a definable trend. But I think what we've seen, and even though we're coming off what was the lows in March, there are a number of other very identifiable demographic and societal factors going on that suggest that housing prices are going to be supported quite well, except for maybe in the big urban areas where, and I'm talking, you know what I'm talking about. I'm talking about New York. I'm talking about maybe the Chicago. I'm talking about area in very high tax states, some of which also have city taxes, states that have very high real estate taxes, and states that have had very recent outbreaks of not just protests, but violence at a ridiculous level, stores being, storefronts being vandalized, broken, and people eating at outdoor restaurants being just egregiously harassed as they're trying to enjoy a lunch or an evening meal. Um, and eating outside because they're not, a lot of restaurants have set up, you know, tenting and shade areas outside, even encroaching onto the streets. I see it in New York because the traffic's down so much. It's not an issue, but there's way too many incidences of these uh, thug groups going around the big urban downtown city or city areas harassing people that are trying to enjoy a pleasant lunch in the slightly cooler weather we've had over the last couple of weeks. That we're not running like 90-95 like we were in July and early August. So you've got people going out of the cities. Real estate prices in New York are down as much as 15%. They'd probably be down a lot more than that. Real estate's just not nearly as transactional as the stock market. And prices in the suburbs are up. So to answer your question, Plank, yes, prices are going to do very well in the suburbs and beyond, especially as people feel more comfortable that they can work effectively from home, at least for a good chunk of the week, rather than having to go into a big office in Midtown Manhattan, where maybe they're not even encouraging people to go in yet. Yes, most prices around the country are going to hold up. Another question here: is the tariffs from USMCA going to make housing even more pricey? I think right now housing, the price of how going up is really just a supply and demand factor for homes. You've got a shortage of supply. I know that there are some tariffs with lumber coming from Canada. And, you know, look, I just don't think it's that high a percentage of the total cost of the house that's going to escalate the price. What's going to escalate the price on housing is extremely low mortgages, 3%, maybe even a little bit lower. I think it was 2.91 today. And um, just a lack of physical supply of new homes and and people wanting to move out of apartments and condos in the city to larger to homes where they're very comfortable spending um, most of the day and then most of the evening. So um, let's continue talking about the market action a little bit. To transport average had a nice day today. Airlines were reasonably strong. Um, Transport's up 80 points to 11,205. 11,205. Remember, the beginning of the July, the transport average was trying to break through the 10,000 level. It's 12% higher right now, up 0.7% today. Now, I mentioned market breadth early, market internals, and that usually means the advanced decline line. We could talk about the new highs, new 52-week highs. We could talk about up volume, down volume. The best barometer is usually the advanced decline line. And for the NYSE, it was positive by a little bit less than 3-2. You had 1,660 advancing issues. You had 1,300 decliners. NASDAQ still a little bit negative. Not quite by 4-3. You had 1,550 advancers and a little over 1,800 decliners. But the NASDAQ was down today. So that to me was the negative Brented NASDAQ bothered me yesterday when the average was up 1.7%. It was down. The NASDAQ advanced decline was really no worse than it was yesterday. And the NASDAQ average was down 0.33%. You had the exact same advanced decline line yesterday, and the NASDAQ composite was up 1.75%. So all the price action in NASDAQ is in those big mega cap tech names that are driving the internet traffic trade. I mentioned earlier that a lot of them had just big rallies on Wednesday, maybe sparked a little bit by Salesforce having a very strong move, almost an unprecedented move, up 25% in one day after their earnings report. And then you had a lot of other stocks that were in any periphery of the space that Salesforce is in act very well. Also, some of them reversed and gave up some of those little bit too parabolic gains that they've had, not just yesterday, but over the last few weeks. So advanced declines, you know what, a little bit better than yesterday. I mean, the S&P 500 was up a point yesterday. We had negative advanced declines. It was up 0.2% today. We had positive advanced declines. So we're working out of one of those negative divergences that was a little bit of a yellow flag for the market going forward. I still think there's a little bit of a yellow flag on the market. We're 2 days from the end of the month. And, we'll see how we act going into, a new month next Tuesday. So crude oil off a touch, hold 43. Obviously, the big storm in the Gulf is a big story. Maybe didn't hit a lot of the refining capacity in Texas that people were very concerned about that it might be hitting. But it certainly did some disruptive activity to anything in the Louisiana area, and a lot of the offshore rigs that are in the Gulf. Although energy, which has been very much of an underperformer, did a little bit better today, up 1/4%. I mean, it could be up more than that with oil at 43, but it was up 1/4% as a sector. Um, and that's very different from the big divergence we saw there. So the worst acting sectors in the S&P 500: communication services and consumer discretionary. Obviously, communication services, that's part of the internet traffic trade. Now, there were some sectors that acted very well, highlighted by financials, which we have been watching closely because it's been frustrating to watch them, almost painful to watch, just continual deterioration in the sector. We had a little bit of a move up early in the week, a pause on Tuesday and Wednesday, and they're up 1.7% today. That's a positive sign for the financials. They may have been helped a little bit by the Fed's comments. And we're going to get to the Fed comments in just a minute. Q2 GDP, we got the first revision, the second look, but the first revision, it initially came in with a minus. This is for the second quarter. This is the big decline quarter. Came in at minus 32.9. It was revised a little bit better to minus 31.7. Now you might say, look, what's the big difference? It was down 33%. Now they've revised it to down just over 1% less than that. It's not that big of a revision, but we watch revisions for all of these economic data points closely. The initial look is done with a lot of surveys, and then you start to get a lot more hard data come in. So when revisions are positive revisions, that usually means that the underpinning of that data point is improving. When they're negative revisions, that's a warning sign that the next couple of reports on that topic are very likely to be negative. Just bear with me 1 minute. So, John has a question here. Trying to raise low inflation with low rates. How is that possible? Well, John, it clearly hasn't been possible. Closing in on first 100 YouTube subscribers. Yeah, closing in on it up to 93. Okay, John, it has not been possible for the last decade. And what the Fed did today, I think, was not only was it a very smart move, I think it also signals that the Fed is absolutely and 100% opposed to even considering negative interest rates as a policy tool like we have. Now, they didn't say this specifically, but I think this is a byproduct of what they said today. They are just absolutely opposed 100% to the possibility, any possibility, of using negative interest rates as a policy tool to on the stimulus side of the economy. So let's talk about what the Fed did today. Now, for people who have had economics 101 or 102 in college, and again, depending on when you had it, I mean, there It wasn't that long ago. Well, it was a long time ago. I'm not going to date myself, but the field of economics is certainly not as mature as a lot of other fields are. Um, and there's been a lot of deeper understanding of um, what economic policies work under what scenarios and which ones don't. And believe me, what the Fed did today, this is not Fed Chairman Powell like over the last weekend or over the last, week and a half. Yes, Ernie, 1981, the Fed made a major policy. That was when Paul Volcker decided they were no longer decided, or they made the policy change that they were no longer going to um, peg interest rates. They were going to manage the money supply. That caused very, very high volatility in the bond market. It actually made rates initially, combining with some credit controls that they put on, which came a little bit later, that made rates spike up to just astronomical highs. Um, it was a point in 1981 when the yield on the 30-day T-bill was 21%, and the yield on the 30-year which was the benchmark treasury bond at the time, was 17%. Yeah, if you think about what the mortgage market was like then. Basically, what the Fed said was the Phillips curve doesn't work in a period of prolonged, extremely low interest rates. Okay, I'm not going to get into what the Phillips curve is. The Phillips curve is basically, anybody who's had an economics class, I'm sure, has had the Phillips curve pounded into them as one of the benchmarks of economic policy. And that basically states that there is an inverse relationship between inflation and unemployment. And you've got to find that happy medium where you have some inflation without spiking unemployment. Because the theory is the lower the interest rates, the 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 more the more employment you have. It used to be full employment was 4%, and people felt even at 4% or below, it would create such a tight demand in the labor market that it would cause a lot of inflation, and that there had to be a happy medium where the Fed's mandate from Congress in 1977 is maximum employment and low inflation. And the Fed then, Bernanke in, I don't know if it was '04 or when it was, put the definition on low inflation as they wanted to target 2%. They're not going to target interest rates anymore, basically, is what they said. Basically, basically, the Fed didn't mention the Phillips curve, but they said that what they have observed over the last 5 years, at least, is that there is no direct relationship between low interest rates and full employment. And that would potentially be inverse, because the feeling would be if you had full employment or beyond, you'd get a spike in inflation and a sharp rise in interest rates. Okay. And they said specifically, our view is that a robust jobs market can be sustained without causing an outbreak in inflation. Now, I think if you went back to the 1950s, 60s, 70s, even the 80s, labor was physical labor, and it was a much higher component of the finished cost of goods than it is today. Okay? It was before the personal computer part of the internet revolution. It was before the semiconductor industry really went through iteration after iteration after iteration of Moore's Law. It was before you had just this tremendous explosion in internet, the first few innings of internet and digital commerce, which which really uh, spiked productivity and created a huge one of the factors that created the huge economic boom in the 90s. Yeah, Michigan. Yeah, he's a very well known guy. He's a little bit of a goofy guy. You'll see him on TV once in a while. John, his hair is like, he hasn't combed it in a week at least. I know some people that had him at Columbia. He's kind of a fun guy in the classroom, I've been told. He used to be was a Fed governor for a long time. I am not familiar with his textbook, but I would imagine, as far as economic textbooks go, it might not be quite as dull and boring as some, because I've been told his classrooms are pretty lively. And he's pretty good on TV too, because he doesn't hold back. He doesn't talk in a total academic language. He talks in real world language, even though I'm sure he's a economics PhD. The Fed is trying. If it took the Fed this long to figure out the Phillips curve is useless. Well, John, let's just tweak that a little bit to say that the Phillips curve doesn't work when you have extremely low interest rates and extremely low inflation. And I would say that what I was trying to say before, it's not like Powell just like got up one day and said, you know what, it's not working what we're doing. Let's talk about it for a couple days and then we'll change a couple things. They started a study group on this in 2018. So, they've got three or 400 PhD economists at the Fed, at the New York Fed building in downtown New York. They probably got some in DC, and every Twistman, if you have a comment, I just can't see it. I'm sorry. So I mean, I can see you're saying I'm closing in on 100 followers. Yes, we have some more followers from the last week, and it's the third week of August. So, look, I have realistic expectations. I know that a lot of people just aren't highly incentivized to watch a show on the economy and the market at 7 p.m. at night. But I like it better than doing it during the day, because I think a lot of people that are in this target audience probably work or have a lot of things to do during the day. So they've been studying this for 2 years, 2.5 years. They decided 4 or 5 years ago that they were going to study this. And they've been running who knows how many academically, how many models they've run on this. But the other thing that I would say, John, and you might think about this also, the Phillips curve, the conclusion is the Phillips curve doesn't work that well, doesn't work in an environment of extremely low interest rates. You know what? In the 1970s, when we had stagflation, which was very high unemployment and very high interest rates, the Phillips curve didn't work then either. So maybe the Phillips curve doesn't work at extreme levels of interest rates and unemployment. Um, that being said, I thought it was very positive that this was a unanimous decision by the Fed governors. Even Esther George, who is the president of, I'm going to say the Kansas City Fed, who is probably the most hawkish Fed member, voted against cutting rates the first couple times that they cut them. She voted in favor of this policy. All of the voting members voted in favor of it. And all members, even those that weren't voting members, all 17, were in favor of it. So this was a study that they had going on for well over 2 years. This was not in response to the coronavirus, although it probably didn't hurt. But this was not something that just in the last 2 months, Chairman Powell has said, you know what, guys, we got to maybe think about doing something a little bit different. This was a study that started well over 2 years ago, that they've been crunching numbers through every model and simulation you could possibly dream up. And what they're going to do is they're going to let inflation run hot. If it goes above 2%, they're not going to say, "Oh my God, we've got 2% inflation, or we've got 2.05% inflation. We need to hike rates." Okay, or they're not going to say, "Look, inflation's gone from 1.6% to 1.7% to 1.8% to 1.9%. It's clearly going through 2%. Let's be proactive because we're always criticized for being too late to do stuff. And let's raise rates now." They're not going to do that. They are definitely not going to do that. They are going to wait till it gets to 2%, 2.10, 2.15, and there can, for maybe a few months, maybe 3 quarters, there, until they are convinced that they have a floor of long-term 2% inflation in the market. Now, does that mean that if that helps the economy, you're going to have rates go a little bit higher? I would like to see rates go above, on the 10-year, go above 0.8%. I'd like to see them go closer to 1%. I think it would be a sign that the economy is very healthy and that it's got some a little bit of steam behind it, and that it can follow through. And I'd like to see it go up there for not just like a week and then come back. All right. 2 weeks ago, we got up to 0.72 on the 10-year. We pulled back to 0.65. Now we're right back up there. We're 0.69. Okay. I think that's maybe one of the reasons that the financials, I really think that to take this conversation to the next level, I mean, in terms of like what really good Fed writers were talking about today, like in the Wall Street Journal Online, Nick Timmeros and a couple of other people. Interest rates can go higher before their measure of inflation really significantly goes higher. That will help the dollar. That will be a sign that the economy is strong. And look, I wouldn't worry about the borrowing cost of businesses going up a little bit, because if the government doesn't raise their benchmark rate for the treasuries, the cost of government borrowing money is going to be very, very low for, I used to be saying out until at least mid 21. There's no way they'd raise rates till mid 21, or maybe even at least the third quarter. Now we might be talking early 22 to mid 22, but we'll have to see. We'll see what happens. Look, if they get the spike, we get the spike in inflation, and the economy all of a sudden is like, unemployment goes down to 6%. That's a different story. But the Fed they are not going to preemptively hike rates to halt an increase in inflation before inflation gets above 2%, and they're convinced it's not a blip, it's going to stay there. So, they've been sort of targeting interest rates, but not really on a hard formula. They're not going to do that anymore. So, look, we did have jobless claims today. Almost seemed like an afterthought. The market almost had no reaction to it at all because Powell started speaking at 9:00. But the initial jobless claims, which were 1.1 million the prior week, what came in at around 1 million this last week. So that's a decline. Still a little bit higher than what it was a few weeks ago, but maybe that jump up to 1.1 was a blip. Continuing claims stayed about inch from where they were, and then we had that revision in GDP. So it's 740. I don't have a whole lot else. I certainly appreciate the support of everyone watching the program. Um, I love the questions in the chat. And yeah, I see your comment there. The Dems need to open up the states. I think you're going to get more and more pressure on that. I mean, look, the virus count numbers are way down. You're gonna have schools opening, and you get schools opening in Florida right now. You got schools opening in a few other places, a lot of other states opening schools. You're gonna get a lot of pressure from parents and parents groups to open schools in states where they're dragging their heels. It's just it's just inevitable. Um, so anyway, look, we had I like a couple things in the market today. The Nasdaq cooled off. S&P still has a little bit of momentum behind it, but it could cool off a touch also. Um, Friday tomorrow, I think we're going to do a show at the end of the day. Friday tomorrow, at the end of the day, you won't see it in the market action tomorrow. You'll see it maybe Monday. You've got the 4-for-1 stock split from Apple. You got the 5-for-1 stock split from Tesla, and then you've got the 3 stocks going into the Dow and the 3 coming out. That's effective at like 401, 402 at the end of the day, Friday. So you won't see that in tomorrow's price action. Tesla will still be trading above 2,000. And Apple will still be. Somebody help me with what Apple's price is. 1,500, something like that. But no, Apple's not 1,500. Apple's 500. Apple's 500. Laptop sales off the chain. Yeah, anything to do with people working at home. I've been trying to buy a Logitech webcam for 4 months. You just can't get them. They're totally out of supply. So anyway, that's the show for tonight. Everyone, if you have not yet subscribed, please subscribe. Hit the like button next to it. You'll get notifications of when the next show is. It's the Anderson Report on YouTube. It's TJ Anderson 12 on Periscope. My Twitter handle is TJ Anderson 1. And I appreciate all the support from all the watchers. I got one other question here that maybe I'll address. Tim, do you know if a trade is done as not held? That won't show up on level 2 trading, will it? I think it'll. I don't know how to give you a definitive answer on that. If it's not held as a market order, it's just going to get executed. If it's to bias, I don't know that there is such a designation now as limit not held. I think all limit orders are taken as held orders, and a limit. Well, if it's a limit, it's going to be bid at that limit. It's supposed to be represented at that limit in NASDAQ level 2. So, if you have an order that you put in with a limit and it's not represented, it either means that if you're a buyer, you're below the best bid. If you're a seller, your limit might be above the best offerings. And if that's not the case, and you have a limit to buy stock at 35 and it's trading at 34.5, you have an issue with your your brokerage order entry system. All right. Thank you, everyone. That's the show for tonight. we will be on tomorrow at 7 p.m. unless there's a late change to that.